On the latest Mortgage Monthly episode from the fine folks at CU Members Mortgage, we have CU Members Mortgage's very own Carrie Fenwick talking about what are most not thinking of when it comes to mortgage servicing. Some great information here from Carrie, so check it out. Everybody, we are live here with CU Members Mortgage's very own Carrie Fenwick with our Mortgage Monthly. Carrie, welcome to the show. And today we're going to be talking about what are most not thinking of when it comes to mortgage servicing. And mortgage, I tell you, has been such a hot topic, as you well know, even during the pandemic and even coming out of the pandemic. I mean, home buying has just been off the charts with what's going on out there. So you guys are busy, right, these days?
We are, yes. You can make a career out of mortgage. Right.
Oh, for sure.
It has been busy.
Well, that's good to hear. So I'm going to fire off with the first question here. I'm going to dive right into it for you here, Carrie. And mortgage servicing seems to be a little more than posting payments and calculating loan payoffs. What are most not thinking about on this topic today?
Yes, absolutely. Great question, Mike. Thank you.
Yeah.
There are a lot of components to mortgage servicing. And I would call it very multifaceted, if you will. So an easy way to maybe tackle this big topic is putting into certain categories. Mm-hmm. So category would be maybe starting out with your general servicing policies. So within that, your periodic billing statements, prompt payment crediting as you are receiving payments from members, and then your payoff statements. So that's one component of mortgage servicing. A second component would be your loss mitigation policies and specific procedures surrounding that. So early intervention should delinquencies occur, and then continuity and compliant contact with said borrowers that might enter into that space. Mm-hmm. And then third spot, if you will, or element of mortgage servicing, and that's going to be features that you're offering. So that can vary. Some organizations will offer escrow services, so your taxes and your insurance, and being prepared to assist with insurance claims, for example, or taxes change annually. So staying up on taxes and insurance, escrow analysis takes place. Other institutions may not offer escrow services, but they still need to be prepared to put resources aside to track and document that those payments are indeed going out timely if members are doing that on their own energy. So within that, then you've got your forced placed insurance topic, and there's tracking that. Also, once you've tracked and determined that maybe there's a policy that's lapsed or is insufficient, the lender will then need to place a certificate of insurance on that property as well. Are you offering adjustable rate mortgages to your servicing portfolio? And if so, there are rate adjustment notices that need to go out. And then lastly, another feature, are you offering mortgage insurance for these loans? And if so, there are annual disclosures and notification of termination should a loan meet a certain threshold where the mortgage insurance is no longer required. So lots of layers, if you will.
No doubt. Well, having said that, isn't it cheaper or more efficient to do it yourself maybe? Or what's the pros and cons here?
Sure. So your size of your portfolio and I think your future goals are definitely things you want to consider when you're looking at cost. And so with that, there are certain elements that contribute to that cost. Staffing. Obviously, staffing is a huge component to your cost to an organization. So not just your back office support for volume, but also staffing that will cover resources of accounting, compliance, and even legal. So there's that. Another big ticket item, if you will, is your software. Mm-hmm. Mortgage loans are not simple interest. So these require a totally separate resource from your consumer loan system. And these software systems range from a highly automated experience to a more manual experience, depending on what you're utilizing. Mm-hmm. So, as an example for us, the module that we use is a highly automated experience.
Right.
So it's going to automate your tasks, your letters, generate these automatically. It's going to track your calls, and then it's going to put all of these within the technology into an imaging repository for easy recall and future reporting. But for those less robust systems that rely more heavily on a manual experience, they'll be leaning more toward that manual task assignment, calendar reminders, spreadsheets. So as you can imagine, as you build your servicing portfolio, you want to think in terms of manageable growth and realistic task assignments to remain compliant.
Yeah, no doubt. There's a lot there, and that's why we have folks like you out there helping credit unions out in this area, because there's so much to think about here.
There are. And then one other piece that I think is fair to mention, not as tangible, would be resolution to errors. So, nobody, of course, intends to have errors as they are maneuvering this relationship, but they can happen and they can be costly. So it's a challenging dynamic to associate a cost to those, but it's something to consider as you're analyzing your servicing options.
Indeed. And so are there risks to consider here as well?
Absolutely. So as I mentioned, risks, mistakes can be costly.
Oh, yeah.
And one thing I think it's fair to mention is that historically, when you're looking at, say, a credit union versus a consumer, and as it relates to maybe errors that occurred, we do see that the legal world might lean a little bit more to benefit a doubt to the consumer. So again, historically, so that's something to consider. So yes, risk mistakes can be costly. There are also regulatory consequences to consider when you're evaluating risk. And then there's department vacancies. So, let's say that you have, a small team or one individual that's just been your rock star in your servicing department. And maybe that individual retires or is out for a period of time. That can put some pains on a department that experiences that. And then that can bleed into reputation risk. So something else to consider in that equation. Another risk I think that maybe is not thought about as heavily as it should is if you have identified as a institution that you do need some assistance in your servicing space and you're looking to a third party to manage that for you, making sure that you have that non-solicitation guarantee. So crucial and such a huge risk, in my opinion, because, let's think about it. That third party has full access to your member, full access to everything that they would need to be able to effectively cross-sell other products and services to that member. And so I think that if you are engaging in a third party relationship, you've identified that you need that support. Non-solicitation guarantee is so key. Another risk to consider, and I think it's kind of near and dear to our hearts, is scale to handle unexpected challenges.
Oh, no doubt.
Last year, we have entered into a pandemic, which, I don't think any of us have ever used that word so often in this last year as we have. So with that comes a lot of challenges and risks, of course, that you need to consider. Forbearance, for example, we have a lot of folks that have had to enter into forbearance due to circumstances revolving around this pandemic. And something that maybe not all are aware of is if you are a servicer that provides escrow services, as an example, those taxes and insurance are still needing to be paid, whether your member is able to make those payments, those negotiated monthly payments. They're in forbearance, payments aren't coming in, those taxes and insurance still are being paid.
Oh, I didn't know that. Wow.
Yeah, so it's, a risk. It's also a cost. So maybe we layer that into the cost. Again, a little bit less tangible of a number to put together, but certainly something to consider.
Yeah, no doubt.
think another risk maybe to discuss would be, or at least think about, is your legal costs associated with loss mitigation too.
Mm-hmm. Goodness, a lot to chew
I
on
know.
for sure.
I know, you're right.
That's why we have folks like you out there to help out and handle all this stuff. So would a credit union member benefit if they outsourced mortgage servicing? I mean, because there's a lot out there. I mean, we've heard stories of, like smaller credit unions may not have the resources to handle these things. Maybe the larger ones do, or vice versa. So outsourcing, tell us about that. I mean, would a credit union benefit there as well?
Yeah, absolutely. And again, it depends on really what they're looking to accomplish in their servicing portfolio, but certainly things to consider as far as outsourcing. You have a quick response to issues, a robust team who specializes, and I think key is they specialize in mortgage servicing. Call centers can be open longer hours than maybe what your institution could offer. You've got online access that's kind of coupled with that software that we talked about earlier. What are those offerings within that software and that online piece for your members? Payment options. There can be some different options within that payment. So on-demand payments, biweekly payments. Those are all things to consider when you're looking at outsourcing, that maybe a more robust approach and a more automated experience for your. And then again, back to that scale of unforeseen hurdles that may come along. These are a team of experts. They are equipped to manage high volume or lower volume, however that might be. There's really no ebb and flow, as you will, when it comes to those resources. And then something else that I think might be fair to mention too is staying up on the regulatory changes. As an example of just April 5th, so 10 days ago, CFPB came out with a proposal for some changes within the servicing platform. And some of those highlights were maybe extending dates out for foreclosure proceedings, maybe giving some leniency to documentation to start the loan modification process, and then also some temporary changes to frequency of contacting the borrower. So these are all still proposals that are out there, but I think a great example of how to stay on your toes about changes that can take place in the servicing world.
Mm-hmm. Yeah, the way I see it is that when you outsource something such as this, that it allows the credit union to do what they do best, which is developing these relationships with the members, servicing them, and meeting their needs. And then the company or the vendors, you guys in that case, can use your expertise and help them complement that and really enhance the value there. So each party really focuses on their strengths, and then it's that old cliche, it's a win-win situation there. So.
Yes. Well, and I like the word you used there, Mike, with enhance, enhance. Yeah. And that's really how we look at servicing, is we are an enhancement to your mortgage team. Mm-hmm. And capacity that need is resolved or provided. We are indeed an enhancement to what the credit union's offering. So,
indeed, for sure.
Word choice.
Yeah, indeed. I want to dig into the weeds a little bit here. So, what is the difference between service released and sub-servicing? What's the
great question? Yes. So, basic difference in servicing released versus sub-servicing is who owns that mortgage servicing right. So, in a servicing released relationship, an institution is going to sell that servicing right to another entity. They may benefit from some income initially up front, but keep in mind that this transaction is transferring that asset and the liability to that servicer. Mm-hmm. They will certainly want to partake in vendor management. There might be some dual functionality in the form of auditing that might take place. They may need to, reach out and gather those resources. But by and large, they're transferring that liability and that asset to a third party to manage that heavy lifting for them.
Right.
A subservicer is an option that allows the institution to retain that mortgage servicing right, mm-hmm. but they can outsource some, many, or all of the servicing duties on that file. It's more of an a la carte approach, if you will. And it's based on really, keeping in mind where their sweet spot is, what they do really well, and maybe what they need some support on. in that relationship. But they are responsible. I want to, heavily kind of push this point that they are still the mortgage servicing right. They own that, and they are still liable for any mistakes that might take place by their subservicer. So something to keep in mind. It's really not a one size fits all in the equation. Choosing between that servicing release execution or a subservicing depends on many factors. Volume of business, best execution, credit risk profiles, and risk management as well. So lots to think about. Indeed. But certainly that a space for everyone, right? Whatever your needs are, you can find that magic formula with the variety of options out there.
Yep, for sure. This is a topic that isn't going anywhere anytime soon. I think it's only going to get more prominent because, as we all watch the news, we go to different news sites and stuff, and mortgage lending is one of the top stories all the time these days, especially just the way the market is going right now. And it's great to have you guys in the credit union corner helping folks out, helping credit unions really, continue or enhance, like we said earlier, enhance their value in this area. So it's really important. So so having said that, anything else to add here, Carrie, to wrap up? Because I know this is some valuable information for credit unions.
Oh, thank you. Yes, I appreciate your time and allowing me a platform to talk a little bit about what's so near and dear to our hearts here at CU Members and Colonial Savings. My recommendation would be for those institutions that are analyzing or maybe regrouping or trying to make a determination of what works best for them to really, reach out to your resources, your peers, those folks that do this and do this well. Mm-hmm. Don't be afraid to ask questions. Don't be afraid to ask for help. You can always look for us at CU Members. We're at cumembers.com. So there in our contact page, you can find us and reach out to us here at CU Members if you want to pick our brains. Mortgage servicing is really a journey. If you think about it, the loan closes and it doesn't end there. It's kind of when we get started, and this relationship with your member can be 10, 15, 20, 30 years of relationship where we get to walk hand in hand with them through their ownership journey. And so, we just consider it an honor here at CU Members to be able to do that. And if there's any questions or any institutions that would like some resources or some support, feel free to reach out. We're happy to help in any way.
Sure thing. Well, thank you very much, Carrie. Appreciate the time today. Great information. And for those folks that may have tuned in halfway through, we're going to have, or maybe the last quarter of it, or just missed it, we're going to have a recording of this on CU Broadcast as well. And we'll have all the links in the show notes so people can get right to it. And give Carrie a call if you guys have any questions about any of this.
Absolutely. Mike, thank you so much for this time. And thank you so much for what you do for our industry.
Oh, you're welcome. Anytime. It's my pleasure.
We appreciate it.
Okay, good stuff. All right, Carrie. Well, I'll let you get back to work. Sounds like you got a lot on your plate, so I don't want to keep you from your job. And everyone out there, stay tuned next month for the next edition of Mortgage Monthly, brought to you by the fine folks at CU Members Mortgage. We'll see you then.